when I hear the word moving average, the two that come to mind to me as very impactful are the 50-day and the 100-day. And
Yeah.
so what are your thoughts on moving averages, the different time frames? Why are they important? And what is your kind of breakthrough into utilizing them to find, opportunities?
I mean, so the 50 and the 200 is famous, right? Because these two, and I actually keep it, if I pull up one of my studies here, you can see I've got this 730, 50, and 200, right? So we're looking at all those moving averages. And I'm going to bring that instead of on the VIX, let's go back to the S&P 500 index. So here's the 200 down here, this light blue or cyan line. The 50 is this magenta. I also have the 30, which is one of our swing trading moving averages that we like. That's the yellow, and our 7, which is quite reactive. These are called lagging indicators. The 200 and the 50, when we look back in time, if I go back, let's just take a look at 2 years worth of data. You could see here how the 50 and the 200 crossed. The 200, I should say that the 50 crossed above the 200. These are considered golden crosses. You'll hear this in even mainstream media, that we just had a golden cross. And the other one, of course, is called a death cross when these moving average crossings cross each other. In reality, so a moving average crossing is called a lagging indicator. It is all about what we try to do as traders. We try to identify tops and bottoms of the market, right? And moving average crossings give us an idea that a top or bottom has occurred behind us. That's why it's called a lagging indicator. And the bigger the number, like the 250, kind of the more either longer term investor you are or more shorter term investor you are. So people who are trading the 50 and the 200, they're talking about year long or decade long positions that they're holding. And so you see a lot of movement of people who otherwise wouldn't be trading when you have a 50 and a 200-day crossing. On like swing trades, I like to look at the 7 and the 30, right? So a little bit faster, where it's kind of on the period of the swing trade. When I'm looking at premium selling, I'm looking at the 3 versus the 5. And if you think about it, and this is again getting nerdy with the mathematicians out there who are tuning in, when you take one moving average and you subtract it from the other, you're kind of taking a derivative. In other words, you're measuring a velocity, right? So when you look at a moving average crossing, it's actually a change in velocity from positive velocity to negative velocity in the markets. But I have a hack for people, because if I come on back, even with my 3 and 5 day moving average, let's go ahead. I have a group of indicators called my faves, right? So when we look at the 3 and the 5 day, and I'm going to pull this guy up right here. This is our indicator that we have that people can download for free. This one that's called the confirming indicator moving average. And you can see I've got a 3 and a 5. I'm going to turn off my filters here. But what I am going to turn on is, with this indicator, you have the ability of turning on the actual lines, right? And you don't have to have my indicator. You could have any 2 moving average lines. And I'm going to zoom in here a little bit to maybe 3 months so we can see this a little bit better. So people who are looking for these moving average crossings, you can see how confusing it is. The moving averages are these 2 lines here, this pink line and this blue line, and you're trying to see if they cross. So I want to give people an easy way to see moving average crossings. So here's what you do. You pull up a generic MACD indicator on your drawing package, the MACD, right? MACD, moving average convergence divergence. And you program it like this. You open up the settings, and you change the traditional settings for your moving averages. So say we're looking at our 3 and our 5. So there's always a fast length, and that's going to be whatever the smaller of the two numbers is, so 3, and then the slow length, 5, and then you change your MACD length to 1. And depending on what kind of moving average, there's different types of moving averages in the charting world. So you might be using exponential, simple, weighted, whatever your moving average crossings are. I'm going to click it over to simple. And then you plot this thing, right? And instead of being all confusing, here, I'll get rid of this special RSI indicator that we also give for free out there for those folks who want to go over to the web portal and check it out. But here is, now it's super easy on this separate little chart to see where the crossings are. It's whenever you get the crossing over the 0 line. That's the same exact thing mathematically as when these two lines cross each other on the main chart, but it's so easy to see, Sip. So if you're ever using moving average crossings, whether it be the 3 and the 5, or if we wanted to go back and program in, gosh, the 50 and the 200, now you're going to get and see, again, I'll pull us back to 2 years. See where that crossing was? That's exactly where the 50 and the 200 day had crossed. So it makes it super easy to see and make it not like speculative.
And the lengths or the time frames are kind of, like you said, fast, slow, short, longer, right? Because I feel like there's a different psychology between the 3 and the 5 versus the 50 and the 20.
Yeah, it's how far out you're looking as far as your trading. Are you looking the duration of the trades you expect to make, right? So if you're using the 50 and the 200, you're going to be buying a stock this year and holding on to it for 5 or 10 years.
All right. So that is the little bit of a breakdown of the moving average crossings. But in terms of the strategy within your indicator, what are those time frames on those moving averages?
Well, you can set it to be whatever. So that's why I programmed this custom indicator. Number one, because you can set them to be whatever. And number two, they also help you see the actual crossing by putting a physical arrow there. And there's some filters you can apply so that, because one of the things I always do is I try to differentiate when I'm looking at my moving average. So I'm going to bring this one back to the 3 and the 5. I put it to 50 and 200 as a, and I'm going to switch it because I like to look at exponentials. So this is now the 3 and 5 exponential. And I like to differentiate, like for instance, if we look down here, you see how this barely crossed and then it came back? For me, that's not a signal, right? You can see how my indicator over here registered that, hey, you crossed, and then the next day you crossed back. But that's, in my opinion, not a tradable signal. So what you can do with my arrows is you can apply some filters that will analyze, not just identify the crossings, but will analyze them and then take them to the next level. So if I turn on, for instance, the 1-bar reversal filter, you'll notice that that arrow disappeared. So it's actually now analyzing how good a crossing that is. So I've just taken a normal moving average and I've kind of simplified it and put it on steroids, a moving average crossing tool, and I've made it available to people for free. But do you need to use mine? No, but I just wanted to give everybody this little hack in order to be able to see the moving average crossings way better than when you're looking at the main price chart and having these two flexible lines and not knowing, am I seeing a moving average or not? Well, now you can tell for sure.